I'm Daita, and welcome to the 25th episode of our Shastrartha series, wherein we discuss the newly issued RBI amendments on banking group entities. So, December is generally conceived to be the season of holidays, but RBI has been keeping everyone on their toes by issuing new directions. So, sir, on December 5th, the RBI amended the Financial Services Master Directions and came up with several restrictions and provisions for group entities of commercial banks, eventually leading to something that can be called as the group-wide regulations.
That's right.
So, if you could first tell us about the impact that these amendments will have on the banks and on the NBFCs and HFCs that are within the banking group.
Right. So most of the banks in the country have several group entities in the businesses organized across the group. Most of the large banks in the country have non-banking finance companies. They would have securities trading companies. They would have asset management companies. They might probably have certain operating entities which are simply carrying operations for the bank. And they might have other investments as well. So essentially, banks in the country are organized through various group entities. Now, this proposition on the 5th of December, as you rightly mentioned, Daita, makes significant changes. Number one, it talks about restrictions on business overlaps, which is very important because banks do what? Banks do lending. And if the bank has a non-banking finance company, that also does lending. So in the past, that non-banking finance companies were typically, I would say, exploited or being used for some degree of regulatory arbitrage, in the sense that what the bank couldn't do was being done through non-banking finance companies. For example, banks couldn't do funding against promoters' equity or so-called acquisition finance. Currently, that's still in proposal stage for banks, acquisition finance. Banks could do loan against shares only up to a limit. Non-banking finance companies could do it without a limit. Banks could not fund against real estate, for example, lend, but non-banking finance companies, non-banking finance companies prima facie did not have a restriction. So in a sense, there was a possibility of regulatory arbitrage between what banks could do and what non-banking finance companies or banks couldn't do, non-banking finance could do. And the RBI had proposed that there would be a sector-wide restriction, group-wide restrictions on banking groups. This was being talked about for quite some time. There was a regulatory proposal in October last year. And therefore, in December 5th, that's one restriction that's come, which is restriction on business overlap. Next thing which has come is restrictions on investee companies, which will also be operating across the group. Now, another aspect here is that the Banking Regulation Act puts a limit on the maximum extent of investee companies' capital that a bank may acquire, 30%, for example. And this is again something that banks were using non-banking finance companies to have a pledge on shares by, let's say, lending against promoters' equity. So what the bank couldn't do was being done through NBFCs. Now here again, the RBI now the 5th December directions put a cap on the extent of the investee company's capital that may be acquired by the bank along with its group entities. That would mean there will be group-wide restriction of 20%. If you want to exceed 20%, you can go with RBI's approval, but max up to 30% in case of the investments made by the bank. Then the third very important point is restrictions on investments in alternative investment funds. And this is something which is, I think, going for last almost 2 years now. December 2023, the RBI put a major provisionary requirements for investments in AIFs. This year, those restrictions were eased. Now, once again, restrictions are getting a little tightened here because now we are talking about group-wide restrictions on investments in units of AIF. So the aggregate investment of banking group in an AIF would be capped at 20. You can once again exceed 20 if you want to. You can do it only with RBI's approval. As regards AIF category 3, which are widely seen as hedge funds, banking groups have completely been prohibited from investing in Cat 3 AIFs. So that's the third important restriction. And the fourth, of course, it talks about group-wide risk management and group-wide management of regulatory capital. Regulatory capital as of now is applicable to banks and non-banking finance companies, but there are other entities, there might be other entities within the group, which might also have similar exposures which do not entail regulatory capital. So on a group-wide basis, that is aggregating assets of the entire group, the bank would still assess adequacy of capital. I would imagine this would also include ICAP, internal capital adequacy assessment as well on a group-wide basis. And on a group-wide basis, the bank will also manage risk. Risk management also will therefore take a para-group view, not just limited to the entity itself. Finally, a significant point is on the so-called referral activities, because this is another thing which banks constantly refer their clients to the securities, entity, which in turn refers back its own clients to the bank. Now here the RBI doesn't want any kind of reputational or operational risk. The RBI says if at all you are carrying referral, do it on a complete no risk participation basis. Neither would the systems nor the properties or the offices of the bank would be used for cross-marketing any services. So any such cross-marketing should be done without the uses of the brand name of the bank. This is true for referral. As regards agency services, there's a clear distinction between referral and agency, and I think Leta, maybe I think you or one of your colleagues wrote on what is the difference between agency and referral. So the RBI directions also bring the distinction and say as regards referral, you will not use the logo of the bank and you do it on complete no risk participation basis. In our view, even participating in the surplus or profits of a referred business, that also in a way amounts to participation risk, because if I get lesser profits and therefore I'll get a lesser referral commission, that's also indirectly sharing the rewards. So sharing of rewards also in our view amounts to sharing of risk. So these are the 5 major restrictions on the 5th December circular. As regards the first one, the business overlap, just to supplement by saying that it's not a complete no-no for the overlap. It's not complete prohibition. On the contrary, the board of the bank, and therefore I would mean the board of the NBFC as well, would decide on what business will be commonly offered by the 2 entities, but then the board will have to come with a granular and tangible justification as to why the business being carried in both entities. And the overlap will be justified by tangible explanation, for example, specialization, branch presence, geographical presence, etc. So there has to be a tangible ground for the business overlap. Otherwise, you'll kind of ring fence activities across the different entities in the group data.
Right. So what is the genesis of these directions? Are there any similar concerns that were observed in other countries due to which RBI has now issued these directions?
Correct. Yes. The background to this lies partly in the global financial crisis, 2007 onwards, where also regulators realized that more complicated and more diversified banking operations are the socially vital organs of the bank. What is the socially vital organ of the bank? That's deposit taking. Because bankers ultimately are sitting with depositors' money. And bankers start risk taking by engaging themselves in various activities, which could probably be proprietary trading as well. The bank might start proprietary trading, let's say in derivatives, let's say in equities, let's say in risky products, which might bring up losses. Now, these losses ultimately get transmitted to losses to depositors, which soon becomes a system-wide risk. That's what we refer to as the risk of contagion. So, in order to limit or sort of insulate the risk of contagion, post 2007, the larger view was that banking companies should restrict themselves to largely banking business, retail-focused activities. As for other businesses, the bankers would probably have to have separate entities which are completely ring-fenced. So this rule was called the famous Volcker rule post the Dodd-Frank Act in US. This rule was also enacted by Bank of England starting 2019. This was called the ring-fencing rule. Singapore also has implemented similar rules years back called anti-commingling rules. HKMC in Hong Kong also has similar rules. FSA Japan also has similar. So various countries across the world have similar rules. In India, this rule was partly brought when the non-operating financial holding company model was implemented for banks years ago, 2013, but NOHFC itself has not been a great success. So RBI, Dr. Mohanty Group recommended, I believe in 2020, this segregation of activities across banking entities, post which the proposed directions were issued in 2024. So it's culmination of a long discussion, and of course it's backed by similar restrictions in lots of other countries as well later.
Right. So initially when the draft was issued, it was proposed that a 2-year implementation timeline will be provided.
Correct.
So now when we have the new directions, can we say that this 2-year timeline has been provided?
Now that's a tricky and I would say disturbing part of the entire regulation, because if, in 2025 when the RBI proposed, it said we'll grant you 2 years time. IBA, of course, represented back to the RBI saying 2 years is not enough, give us longer time. And in the comments received to draft proposals and the RBI's responses to the comments, which is just an annexure to the 2025 December 5th directions itself, the RBI is gone on record saying that request was made for longer than 2 years. However, the request was not granted. That would mean they agreed to retain the 2-year implementation time. That seems a little setting back to see that in para 19 of the very same regulation, it goes to say that affected businesses, overlap businesses, you can continue to service post 31st March 2026. We're talking about therefore barely 3 months time, a little more than 3 months time. But from 1st April 2026, overlap business, you will stop undertaking new business. So in reality, it's not 2 years at all, it's just 3 months, particularly for the overlap business, unless the board comes up with a justification that whatever we're doing is perfect. I think to say that the board justifies all that we're doing is then making the regulation completely defunct. So on the contrary, we say there are structural changes that we need to make pursuant to the 5th December directions, then the real implementation time is barely 3 months. Now, what makes me really little worried is that the last quarter of the financial year is the year for banks to give a push to the business. That's the year for booking business, particularly in a situation where we're facing a lot of headwinds due to global tariff restrictions and what all. This is the time when banks should be busy doing business. Now, in this sensitive quarter, banks would be busy repositioning their activities. Seems a little, I think, odd for the last quarter. So I think there is still a concern. I hope the RBI would realize that they did not grant what they actually promised, and therefore they might be willing to relax this timeline. But as of now, it seems like it's just 1 quarter, not 2 years.
Right. So these restrictions are for banking group entities. So when we say group, what do we actually mean by group? Because I understand that banks would be following the IGAP norm,
right,
whereas their subsidiaries, that is the group entities, would be following India's.
That's right.
So which definition do we take?
So first of all, let's understand the meaning of group entities. Group as per accounting standard definition, which means it will include subsidiaries, it would include associates as defined in the accounting standard. Now your question is, which accounting standard are we talking about? Because the accounting standard applicable to the bank and that applicable to the NBFC in the banking group will be different. The NBFC will be obviously adopting India's, bank will still be going by IGAP. As we need to identify the group for the bank, I think it would be fair to say that we'll go by the IGAP definition and not the India's definition. Therefore, whoever or whatever is identified as a subsidiary or associate as per IGAP definition, which means 20% equity capital or 50% holding of capital, that is the definition that should be taken. I think that's my way of looking at things later.
Okay. So these directions state that there should not be any overlap between the bank's products and those offered by the group entities, the NBFCs and HFCs. So in this case, what does overlap mean and what impact will it have on the banks? So how do we decide on what basis, what entities would be providing what all products?
So we are talking about on what basis will the board of the bank, because I think this is a call on the board. The board should sit back, decide what is the overlap area, what are the overlap areas, and how do we minimize or kind of justify. Either we curtail or eliminate the overlaps, or we justify the overlaps. Justification is not, once again, maybe it's not like blanket or kind of vague justification. It has to be tangible justification to say that I'm carrying overlap despite the regulatory principle of avoiding overlap. I'm still carrying, and I have the following justification to offer. So let's understand the bank will either eliminate or the bank will try to justify. Assuming the bank tries to eliminate, the question is on what basis banks decide what to do in which entity. Some businesses, for example, are completely bank specific. For example, let's say priority sector loans. Now, banks need PSL lending, NBFCs don't need PSL. But at the same time, we understand quite often NBFCs are deployed as the originating arm from where the business is thereafter acquired, either by way of a direct assignment or by way of investment in pass-through certificates. Assuming, now that's exactly where the difficulty comes. Assuming the bank decides that it's the bank which does priority sector lending, or assume the bank decides that my NBFC will do, let's say, agri lending, for example, lending against tractors. If the NBFC is the entity which does lending against tractors, once the NBFC originates tractor portfolio, can the bank acquire that, saying that I'm still leading it for my PSL benefit? So if you're deciding by a board resolution that you will have PSL lending or agri lending done at the subsidiary level, thereafter the bank acquiring that will also become difficult to explain, because what I couldn't do myself, how can I therefore acquire exposure in those very loans by buying in the direct assignment transaction? So I think this choice is quite tricky. The choice is not something which is like an annually changing flavor. You need to decide for a long run. You need to decide basis the capability or the geographical ability of the non-banking finance company in the group. You might need to decide on the recovery strength, your ability to carry out risk evaluation, technological strength. Various factors might go into choosing which product should be dealt with by which entity. But having made the choice, I think even the acquisition of portfolios by way of a direct assignment or even co-lending within the banking group entities, to my mind, will become tough. So segmental or let's say group-wide allocation of business would also mean that the moment we decide one entity does a particular product, then we will not interfere in that either by way of direct assignment or by way of co-lending. Acquisition of pass-through certificate is still okay, but buying loans by way of direct assignment or co-lending, to my mind, that will also be ruled out given the focus on a particular product. Later.
So apart from this, some investment limits have also been introduced for banks and the bank group. So could you give us an overview of the investment?
Correct. So the major investment limits are twofold. Number one, investments in alternative investment funds, and number two, investments in investee companies. There is, of course, a limit which is the bank's own NOF based limit. The maximum investment in the bank may make in capital market instruments will be limited to a particular percentage of the bank's own NOF. But I think more significant here would be the investee capital based limit, which is saying on the group-wide basis, the banking group shall not hold more than 20%, in fact less than 20%, can be acquired by the banking group in the investee company's capital. 20 to 30 can be acquired with RBI approval. Above 30 cannot be acquired. Above 30 becomes a stat restriction that cannot be acquired at all. Now here significantly, shares which are held for trade, HFT, HFT meaning the bank has acquired shares for a pure trading purpose, with just trading purpose, which is regarded as held for trade, which means a daily mark to market. That kind of portfolio will stay excluded. In addition, investments made by the mutual funds as a part of the fund holders capital, that will also be excluded, though the investments made by the AMC out of its own funds will be included. So just to make it once again clear, investments made with bank, investments made by the AMC, which is invested out of the AMC's own capital, and investments made by other group entities will all be aggregated for computing this investee capital limit. Additionally, I was mentioning even investments in AIF category 2 have been limited, category 1 and category 2 have been limited. Investments in cat 3 has been completely prohibited. Later.
So earlier in 2023, RBI first came out with the AIF directions, where certain investment limits were proposed. Then again, these directions were amended in 2025. We have the AIF directions.
Correct.
Now, the present circular also talks about some AIF investment limits. So how do we read the entire thing in aggregate?
So in the aggregate, it's still indicating some degree of, regulator trying to readjust or reconcile with the need of, investing through the AIFs. At the same time, it's also aware that AIFs have or may be used for a bit of what you call regulatory arbitrage, particularly the so-called private credit AIFs, because private credit AIFs basically are doing what? They're primarily, almost like engaging in lending activity, because they're investing in so-called bonds, which are nothing but direct credit substitutes. So to the extent the AIFs were being used for regulatory arbitrage, RBI wants the group-wide restrictions on investments in AIFs, and RBI is somehow not happy with banks investing in hedge funds, because that's exactly where the risk of capital market volatility could come into the banking group. So RBI wants to insulate that risk completely. Therefore, for investments in AIFs, yes, you're right, the approach is evolving, because what began in December 2023 as a major provisioning requirement was relaxed quite a bit in, I think, June 2025. And once again, we have this change. Now, this time, the RBI clearly says that if at all there are some investments which are exceeding the limits, for this one, you still have a 2-year time window. So 2 years time window is applied for this, but not for the rest of the, particularly the provisions of para 18, which is talking about business overlaps.
Right. So talking about the referral business, the directions provide that banking group entities can only undertake such referral business which the bank can undertake. So what does this imply for these entities?
So in terms of the structure of the statute, the statute talks about businesses in which the subsidiaries of banking groups can, or banking companies may engage. For example, Section 19 gives a list of activities which bank subsidiaries may engage in. Section 6 talks about the business of the bank itself. So wherever we're talking about business of the bank itself, for example, deposit taking, that business will have to stay focused within the bank itself. Now, as regards other subsidiaries, the subsidiaries may carry such businesses which are permitted in terms of Regulation 19. Now, in addition to businesses which the bank can do and the businesses which bank subsidiaries may do, banks also quite often do what you call referral activities. They refer, for example, a stockbroking client, they refer to either to their own group companies or they refer outside the group. So here the RBI is making several significant provisions to say that if at all you're doing referral business, you will do it without using the bank's trade name. You'll do without the bank's brand name, part one. Part two, referral meaning you will just refer and then completely remove yourself from the scene. You will not be engaged in subsequent business negotiations, or you'll not anyhow expose yourself to give the customer a kind of impression that it's business of the bank. The bank is simply a referrer and the bank is no longer engaged in that business. In addition, the business will be done completely on no risk participation basis. And additionally, it's also bringing a distinction between agency business and referral business, which was not, I think, completely clear earlier. So the so-called DSAs, or acting as a BC or DSA, that's basically still an agency business. Pure referral, meaning I'm simply referring, completely exiting myself. Neither am I allowing use of my technology platform, nor will I allow the use of my property, nor will I allow nor will I take any share in the returns of the business. So that's the essence of the so-called restrictions on referral business data.
Right. So that's it from my side. We have some questions. Ms. Ritra is asking that as per the RBI directions, is there any restriction on undertaking corporate LAS business or only individual LAS lending?
Okay, so put it this way. First of all, as the rules applicable to banks primarily talks about loans given to individuals for investment in capital market securities. And I think the proposed investment limit is now rupees 25 lakhs, which is in the draft directions, which is in the investment direction, which are still in draft state, because that's the acquisition finance direction that we're talking about. As regards loans to companies, that is so-called corporate LAS, the moment you talk about lending to a corporate, there it partakes the character of funding against private equity. Because there the corporate would basically use this money to make a downstream investment in group entities. So there it becomes a sort of investment in private equity. So far, there was no restriction on non-banking finance companies and lending to corporates for investments in capital market securities. Because of the 5th December directions, now as I mentioned, the restrictions applicable to the bank become extended to the group entities as well. Therefore, up to 31st December 2026, you can continue what you do, continue servicing what you're doing. But beyond that, I think this would probably, to my mind, this might even get immediately applicable, because there are 3 implementation dates. 5th of December is the date on which the rest of the provisions become applicable. Para 19 talks about 31st March 2026. And the investment restrictions talk about still a 2-year time window. But this one, because we are talking about the NBFC in the banking group should refrain from doing what the bank is prohibited, one might take a view, of course it requires a bit of further reading, one might take a view that this restriction seems it becomes applicable right now. That would mean on and from 5th December. Now I'm saying I'm doing a loud thinking because I'm not able to read the regulation and provide a research answer right now, but it appears that it might be that from 5th December, a corporate less, which is loan against shares held by corporate for primarily for investing in, promoted entities, group entities, will stand prohibited rather than permitted until the capital market investment directions, which are still in draft stage, they become finalized.
Okay. We have one more question, which is to consider restructuring. Can a holding company be formed as CIC, not required to be registered with RBI?
Well, but how would forming of a CIC at all help? Because a CIC cannot do business with anyone else. So CIC is basically only for holding the shares within the group. So if I form a CIC and I structure the CIC such that it doesn't require registration. For example, I have to be 90% invested within the group. I cannot hold any public funds. I will not have any customer interface. So if anyway I don't have a customer interface, the very purpose of forming a CIC to stay out of the restrictions will be frustrated. So I see no purpose being served by forming either registered CIC or unregistered CIC. Unregistered, registered, the implication is still the same. Either way, a CIC cannot have a customer interface.
So that's it in the chat box. Are there any participants who would like to unmute and ask the question? Then you would please do so.
Participating.
Yeah. Hello. So, Richard, this side.
Yes, ma'am, we can hear you.
Yeah. So, one of the query that we have is that if I have to restructure any holding entity, is it necessary for me to constitute that holding entity as a NOFHC? Or, is there any other alternative to not consider a NOFHC and register it as a CIC, who's undertaking business? I mean, what would be the best recourse for a bank-led NBFC to ensure that there is no overlapping of business and still continue to pursue the forms of business?
Okay. So, ma'am, it's like this. Once again, I'm giving what you call, I'm thinking, try answering. The NOHFC model came in 2013, sorry, and was mandated for all private banks which were given banking license post 2013. So all the so-called new age banks, new private banks which came, they all came under the NOHFC model. We have seen over time some of these NOHFC got merged with the bank itself, and therefore currently there are, I think, very few banks which are still working under NOHFC model. For an existing bank, particularly like I think you are probably representing Standard Chartered, for an existing bank to have an NOHFC, I don't think it probably merits this. I don't see much of a merit in forming one. Now, if you were to think of, let's say, the shares of a non-banking finance company being held by an NOHFC, I don't know how would it actually resolve the issue, because ultimately the capital of the NOHFC also, unless we're able to see, well, there might be a offshore investment in the NOHFC or the holding company, which in turn will hold the NBFC, and therefore the NBFC ceases to be a part of the banking. Now, this might probably seem like a potential structure whereby we're saying because the NBFC is held by another holding company, which in turn is held by, let's say, international investors, and therefore the NBFC is not a part of the bank group. And because it ceases to be a part of bank group, therefore it ceases to be covered by these restrictions. This once again might be seen in some kind of a different light by the regulator. The regulator's whole intent is that if you're seen as an NBFC belonging to a banking group, then you adhere to the restrictions, not try to find a cute way to, avoid this. So, subject to, like I said, subject to discussion though. But this, while may be seeming like technically feasible, but will it avoid the regulations which are intended basically for banking group, non-banking finance companies? In my, substantive approach, not really.
Okay. And sir, just one more query is that on the previous answer that you gave, that am I restricted from pursuing corporate laws? Like when I refer to the banking, the commercial banking regulations issued by RBI and the restrictions that they have on their bank-led NBFCs. So while they say about borrowing against shares, it's not exactly clear if it implies only loan against shares with respect to corporates or individuals. So there is some view currently being analyzed that there is no restriction on corporate laws. But sir, is there any guidance that you can share with us on that?
So question basically, when the RBI talks about loans against shares, the RBI is not meaning to provide lending for investments within the group. So I'm not sure whether the corporate in question is making a diversified investment in capital market, or is the borrower in question investing within the group. If you're talking about investment within the group, then that's actually not the intent of the so-called LAS. Loan against shares as a product is essentially meant for making investments in the capital market, not investments within market. If you're talking about investment in capital market, then probably you're right in saying that whether you're lending to an individual or lending to any other entity, it shouldn't matter. But I think the existing loan against shares guidance for banks, circular for banks, which is quite dated actually. In best of my reading, it refers to loans to individuals. I'm not having the text right now, therefore I wouldn't be able to. Like I said, I'm just giving off the cuff answer without a proper research. The proposed changes to the directions, which is still a draft at this stage, I think intends to amplify and intends to broaden the extent of funding that banks can do to for investment activities, including investments, including lending to promoter shares as well. That's sought to be permitted now, but permitted subject to several caveats. So that is still in draft stage. I think one may expect that this might be finalized soon. But existing loan against shares product, now it seems to my view that this is intended for lending to individuals, but surely not lending against investments within the group. That's not the intent of loan against shares.
Okay, sir. Thank you.
Pleasure. Any other question that anyone else might have? Well, if not, in that case, Neita, we should be thankful to all the participants for participating.
Sir, one doubt from my side. Myself, Senthil from HDFC.
Right, sir.
So what I want to understand is uh, that one point that they are telling, banks will there shall be a policy for each form of business undertaken by the bank, which comprehensively covers various aspects of said business, including identification of various risks associated with it, and appropriate risk mitigation framework, and adherence to capital allocation norms as applicable. So here, the business undertaken by a bank, which is talking about the bank, or it's a banking group. Just want to understand.
So there are two parts. Number one, group-wide capital allocation and group-wide risk management. I think towards the end of the circular, I think towards later part, it talks about group-wide risk management and group-wide capital management. But before that, it talks about any activity undertaken by the bank. The bank will do it in pursuance of a policy, which will also discuss the inherent risks and also the capital required for the business. So sure enough, any business which the bank does is obviously backed by capital. Because capital rules are applicable to every bank. What the regulator here is trying to say is that in addition to capital, you'll also identify the internal capital needs based on the ICAP assessment done by the bank. And of course, do it basis of policy, not based on kind of arbitrary choices. Which means it has to be policy based. Whenever a bank decides to allocate business across the group, it's based on a policy-wide choice. So, in a sense, this will be operating both at the bank level as also applicable at a group level, because there would be there is a paragraph dealing with group-wide capital and risk management as well. Now, when it comes to credit risk consideration, or the capital requirement itself. Now, the credit risk concentration is still, for example, the group-wide concentration limits or individual borrower-wide concentration limits. These are still applicable to the bank. They are not applicable to banking group. The reason is quite obvious because these limits are defined with reference to the bank's NOF. Since we're talking about the bank's NOF, not the group NOF, we are not aggregating the NOF. So we're not aggregating credit exposures. We are aggregating investments like we just discussed. We are aggregating AF investment like we just discussed. We are aggregating the group for risk management and capital planning viewpoint. But we are not aggregating investments by the group either for large exposure framework or for borrower-based concentration. That's my reading.
Thank you, sir.
Great pleasure. Right. Daita, I think we would like to wind it up with thanks to everyone. Thank you very much. And please do keep watching it. Please do keep participating in our events. And as we are still almost walking into a festive season, Daita mentioned that RD keeps us busy, but we still have life beyond dealing with the directions. So please do enjoy your time and wish you all the very best.